The S&P 500 up almost 15% year to date, with Friday ending its fifth straight week of gains, the index's longest streak since November 2021. The Nasdaq Composite is also on a roll. It's up for 8 straight weeks. Citigroup strategist wrote in a recent note that positioning in U.S. equity futures is very bullish, and now at the most extended levels for the S&P 500 and the Nasdaq 100 in data going back to 2010. Joining us now from the New York Stock Exchange to show us what all of this means is Yahoo Finance reporter Jared Blikre. Jared, what does it all mean?
Yes. All right, well, we got a parade of people that may or may not get in my shop, but let's go to the Wi-Fi Interactive because a picture is worth 1,000 words. We got S&P 500, as you said, Julie, up about 15% year to date. And as Citi is writing, we're seeing the highest positioning since 2010. Now, that's actually, when we get to extremes, that can be a contrary indicator in the very short term. So JP Morgan, for instance, is writing separately, could see a 5% pullback from current levels, but also, we know that markets can stay extended and overbought for much longer than you or I can stay solvent. I thought I would digress here for just a brief second to go over some of Marty Zweig's legendary Wall Street investor, some of his investing rules. Number one is the trend is your friend. Don't fight the tape. And we talk about the Fed and not fighting the Fed, but look at this. Number 6, all the way down, 5 levels down, is don't fight the Fed, less valid than number 1. So technicals and the trend trump all, even the Fed. And as we've been talking about, a number of Fed speakers getting together or actually speaking this week, probably going to drop some news. But the real fireworks, we don't have a huge major catalyst until earnings season, and then we'll get some more CPI data and PCE data and employment data in the meantime. But nevertheless, we are extended to the upside here. And here's the ICE B of A Move Index. This tracks bond market volatility. This dropped on Friday. This is as of Friday close. That dropped, and we are now approaching the February level. So when bond market volatility goes down, that allows risk expansion into other forms of risk, and that could be equities, it could be anything. Here's a 10-year T-note yield that's down 4 basis points today. Not seeing a whole lot of movement there. So I'm going to move on to some of our heat maps, and we can see consumer discretionary retail. That has done very well over the last month, 6 weeks or so. That is up, but nothing else really in the green today. Energy, real estate, materials, all taking it to the downside, off about 1 or 2%. Finally, here's the NASDAQ 100. We are seeing some weakness in Chinese shares. Has to do with expectations regarding that rate cut that just happened, but investors looking for a little bit more on that front. But Chinese equities definitely trading much differently than U.S. equities this year.